What's up? Today I'm going to talk about the stock prices. I was asked this morning by my wife, how does a stock even get the price that it's selling at? So I'm going to tell you a little bit about that, and we can just kind of talk in general about what's going on in the stock market today and over the last couple weeks. There's been a bit of craziness, so we'll go through that as well. So the first thing in terms of how do you actually get a price to sell a stock? So think of a stock just as like a normal product. When you go to a store, every product in that store has a specific price, which basically means there's a seller who's saying this is how much something's worth, and then there's a buyer who's you, who's going to go pay a certain amount of dollars and cents to actually buy that product. So based off of what that initial price is, you as a buyer get to determine if you're going to actually go through with the purchase to purchase that product. So let's say you're going to go buy chocolate chip cookies, and the chocolate chip cookie, one chocolate chip cookie is $2, and you decide $2 is too expensive. And you, like everyone else in the neighborhood, decides that $2 is too expensive for one chocolate chip cookie. So basically what happens is now that baker, whoever that shop owner is going to say, okay, no one is buying my chocolate chip cookies, so I'm going to reduce the price down to $1.75. And then at $1.75, you might say, okay, that's reasonable now, so I'm going to actually go buy the cookie at $1.75. So basically that's you, the buyer, and the seller agreeing on a price. And so you have basically taken the price from $2 down to $1.75. That's like where demand actually meets the supply, and then you actually purchase the cookie for $1.75. So that's how you determine the price of a cookie in a very simple sense. Before we get too far into this, you better go like and you better subscribe to the Quinn Talks Money channel. And there's gonna be more videos like this because that's what the people want apparently. So bringing that cookie example back into the idea of stocks. So basically it works very similarly where when you're buying a stock, we won't get into too much depth on this, you're basically buying a small portion of a company. So you're buying like one share of a company, let's say, when you buy a stock. And that share of a company has some sort of value associated with it. So it might be $10, it might be $100, it might be $1,000, but it has some sort of value. And that value is going to change throughout the year depending on how profitable they are, how much revenue they're bringing in, what demand's like, if there's risks in the market. There's all these different factors that go into like what the value of something might be. And every single person is going to have a different calculation of what the actual value of something might be. Someone might say the value is $10, someone might say $12, someone might say $8, but everyone's going to have their own idea. So basically when a stock is being priced, you're basically trying to figure out, kind of like with the cookie, where someone that actually wants to buy a share of the company can match up the price with someone that wants to sell. So like on a day like today, prices are down, or the Dow Jones, which is one of the main stock indices, is down by about 8%. So basically what's happening is a lot of sellers are basically allowing themselves to reduce the price that they have to sell their stock at to get a buyer to come in. So on a day like today, a lot of buyers are maybe more concerned because prices are going down. There's a lot more uncertainty with the coronavirus and some new oil things that have come out. So they might value a company less. If they valued it yesterday at 12, today maybe they're valuing it at 11 because there's more risks and they think that the company won't be making as much money for various reasons and lots of other things. So in that case, they're going to say to the seller, yesterday I would have bought it for you for $12, but now today I'm only going to buy it for 11. And that seller basically needs to say, okay, I'll sell it to you for 11, or they might say, no, I want to sell it for $11.50. And then if they actually agree on $11.50, then the price of the stock goes to $11.50. So it's basically just like a buyer and seller actually agreeing on a mutual price that they want to actually do a transaction at. So today, when stocks are dropping, there's not as many buyers in the market. So sellers are becoming more desperate to sell, so they have to reduce the price more until they get to a point where now we're at like 7 to 8% down. So a buyer now, if a buyer wants to buy, they're able to buy much lower than they would have yesterday or the week before as well. So that's generally kind of how stocks are priced, or where you're going to get a price. And so today, why are stocks actually going down by 8%? So basically with the coronavirus, the fear is that when the supply chain is disrupted, it means that companies can't get their products on time to then go sell to consumers. Consumers then can't go buy those products, and that's money, or like the benefit of the economy is then degrading because all these different processes are actually disrupted. So that's one part of this, and then the second part, more so today specifically, is related to oil and gas. So today specifically, what's going on is there's some disruption in the oil industry. So basically what happened is there's this group called OPEC, OPEC. And basically OPEC is a group of oil producing countries, and they kind of get together and they try and figure out ways that they can all work together to kind of stabilize prices, stabilize demand, supply, all these different things, so that instead of the market going like this, up and down and up and down and going crazy, and one country having one price for oil and another country having another price, they're basically able to kind of stabilize a lot of these general processes that happen among companies. In this case though, it's happening among countries. So all these countries got together. Oil prices have just in general been going down recently, and so they were trying to kind of stabilize that, and all of the countries agreed on something except for Russia. Russia basically said, we're not going to cut our supply, and we're actually going to produce more oil and put more oil into the market. So basically Russia kind of went rogue and wasn't willing to sign on to some of the agreements that the rest of the countries were. So then because of that, Saudi Arabia then decided that they were going to flood the market with tons of oil. So basically they're going to start producing a ton more oil and put it out into the market. So basically what happens is when you get more of something on the market, the price generally is going to go down unless demand is as high as the actual supply. In this case, it's probably not. So what's going to happen is Saudi Arabia is now going to produce a ton more oil. The price of oil has now dropped 25% today. So it's at like $30 a barrel, if that means anything to you. But essentially it was at like, 100 a couple of years ago, and it was at like 50 or something like that, earlier, just like yesterday. And so basically now that Saudi Arabia is flooding the market with all this new oil, all these other countries are now like, okay, what are we going to do? There's a lot more uncertainty. And so that's now causing all the stocks to kind of drop off for other more complex reasons as well. But essentially that's kind of what's happening today. So in general, to kind of wrap all that up, stocks are like chocolate chip cookies, and you're only going to pay for a stock what you think is a fair price. So as those cookies become more popular, that baker might be able to increase his price because you're willing to pay more for it. But on a day like today in the stock market, people are less willing to buy stocks. They're less willing to actually go out and put a bet on a company for the long term, and because of that, a seller has to reduce their price to get someone to actually buy their stake in a company. So that is all. I hope you learned a little bit about chocolate chip cookies and stocks and oil and supply and demand. If you have any thoughts, please comment below, like, subscribe. There's gonna be more coming, and let me know what you think. And thank you very much, and I'll see you later.